Hey guys, Darren Sugiyama here, founder and CEO of Lionsmark Capital, the most transparent premium financing intermediary in the life insurance industry. This year, 2023, has been an interesting year, to say the least, in the world of premium financing. Borrowing rates have skyrocketed, and if these clients were not thoroughly informed of the risk of interest rate increases, and if the premium financing design was irresponsibly over leveraged from the very beginning, advisors now are finding themselves in the hot seat, trying to explain to their clients what went wrong and why they had to post so much more collateral, and why they had to pay so much higher interest payments than were previously planned on. Fortunately for us here at Lionsmark Capital, we are not having any of these problems. The problems the rest of the premium financing world is having. One, because our method of educating clients up front, about the inherent risks of premium financing, but also because of our proprietary risk mitigation strategies and stress testing and back testing software that we use to educate clients with. These, special offerings that we offer clients have really almost eliminated those types of problems. Not to gloat here, but anyway, in today's webinar, if you're getting lit up by your clients right now, your premium financing clients, because you did not use Lionsmark Capital when you first financed these cases initially, there is a possibility for me to, again, possibly help you save your client, and equally as important, maybe even save your reputation, by offering you two new lending solutions to possibly refinance your existing cases. But more importantly, offer you solutions for new cases. And if you don't use us as your go-to intermediary, personally, I think you're nuts. But in all seriousness, the content that I'm going to share with you in this webinar is really just one more reason why you should use Lionsmark Capital as your exclusive premium financing intermediary. So let's go ahead and get this webinar started. Okay, so let's start off with one of our new lenders here. This lender offers a fixed 5-year loan, and that rate is locked in as low as 5.35%, again, for a period of 5 years. Very, very unique. Just to give you a little background about this particular lender, they've got $105 billion in assets under management. They are publicly traded, and they've been in business since 1910. So definitely not a new lender on the block. Again, their unique offering right now is they have a fixed rate for a 5-year term. So fixed rate for the entire 5-year period. And the fixed rate is going to depend on where the client is located or where the borrower is located. If they are in one of these states here, Arkansas, Arizona, Colorado, Kansas, Missouri, New Mexico, Oklahoma, or Texas, the 5-year fixed rate is only 5.35%. If they are not located in any of those states, all other states, the rate is 5.6%. Again, fixed for a 5-year period. Very, very attractive right now. So if you have clients that are concerned that borrowing rates are going to stay kind of where they are now, or even increase in the future, this could be a really great solution for them. Gives them a little bit more certainty, emotionally speaking. Now, all of our money sources are basically telling us they expect in the next year or two for rates to drop significantly, about 200 basis points or maybe even more. But if you have clients that like the idea of locking in a fixed rate and not having to worry about rate increases for the next 5 years, again, this can be a really, really great solution. Under this loan platform, they do have a prepayment penalty. That prepayment penalty, what they do is if the client wants to refinance because current market rates in the future are lower than this fixed rate that they have locked in, the prepayment penalty is calculated as such. They essentially take the fixed rate, whether that's 5.6% or 5.35%, and then they subtract whatever that new current market rate is at that time that they want to refinance. They take that spread and they multiply that by the number of years left on the loan term. They take that percentage, and then they multiply that by the total loan payoff, and that is the prepayment penalty that the client has to pay out of pocket in order to refinance with another lender or refinance with the same lender and switch to an annual renewable term rate. So as an example, let's say they had a fixed rate locked in at 5.60%. And let's just say hypothetically, the new market rate when they wanted to refinance was 100 basis points less at 4.60%. And let's assume they had 2 years left on the loan term. So they would take that 1% spread multiplied by 2 years, right? That's 2%, multiplied by, let's say the loan payoff was $3 million. They would take 2%, multiply that by the $3 million loan payoff, which would equal $60,000. So the prepayment penalty would need to be paid out of pocket by the client in the amount of $60,000 in that scenario. They obviously could also opt to just stay in that fixed rate for the full duration of the 5-year term, in which case there would be no prepayment penalty actually assessed or charged. Okay. With this particular lender, the client can just post outside collateral and keep it housed wherever it's at. They do not need to move that collateral amount to the lender. And this lender also accepts a letter of credit as outside collateral. This lender also is okay with foreign nationals. In this situation, the actual borrower must be a U.S. entity that has been around for a minimum of 2 years. So an LLC or a trust or something like that, as long as it's U.S. based. But the insured person could be a foreign national, no problem. From a financial underwriting standpoint, the borrower needs to either have a $2.5 million liquid net worth, which can include qualified funds, or if they show just a gross income of $500,000 a year or greater, that will also qualify them where the net worth is irrelevant. And then the last thing here is they do charge a $3,500 loan doc fee. They have outside counsel draft the loan document. That is the pass-through charge to the client. And that loan doc fee is pretty much par for the course. It's actually on the lower end of loan doc fees that a lot of lenders charge. That is only charged one time up front, and that covers obviously the 5-year duration of this 5-year term loan. And there are no other origination fees with this particular lender. So again, great solution for a client that does not want to worry about borrowing rate increases over time. And actually in the immediate, depending on the size of the loan, a loan rate sub 6% is extremely competitive, even for 1-year renewable term loans right now with most lenders. So again, a great solution for the right type of client. Okay, lender number 2, this is a really unique scenario here. This lender is offering rates sub 4%, which is absolutely insane relative to kind of what the US market is offering right now. So this lender has a very unique proposition here. They're a Swiss-based lender located in Zurich. They are one of the largest banks in Europe, actually one of the top 8th largest banks in Europe. Currently, they have over 31 billion euros in assets under management, which is roughly the equivalent of $34 million under management in terms of US dollars. Currently have over 13 million customers, and their loan is based on the SARON rate, which is the Swiss average overnight rate. Currently, the SARON rate as of June 13th, 2023 is 1.44%, and there's a 250 basis point spread on top of that, which brings the all-in rate to 3.94%, which is an incredible offering right now. This is an annual renewable rate for loans that have a minimum annual premium of $1 million. And again, that is the rate as of June 13th, 2023. So similar to a traditional US-based bank, instead of using the SOFR rate or the Treasury rate, again, this bank uses the SARON rate. Now, there is some risk that comes with this type of loan, and the risk is the foreign currency exchange risk. What I mean by that is that let's say the client is borrowing in Swiss francs when the loan is to be paid off. If the dollar is stronger or weaker at the time of the loan payoff, the client may incur a little bit of risk in terms of needing to come up with more US dollars to pay off that Swiss borrowed amount. And on the next slide, I'm actually going to show you some historical exchange rates between Swiss francs and US dollars, so you can see, historically speaking, how much volatility there has been in that exchange rate. In this particular construction, the premiums are paid to the carrier from a US-based bank. The funds do not go straight from the Zurich-based bank to the carrier. A lot of carriers would not approve of that. They want to see the funds coming from a US-based bank. So that is not an issue with this particular lending platform. Again, minimum size of these cases is a $1 million annual premium being borrowed. And because this is a proprietary lending structure here, the intermediary split is 50% as opposed to our normal split. So this particular lending platform could be really valuable if you have a client that already has a premium finance policy and loan in place. And if they got a loan renewal rate of high 6%, low 7%, that is most likely double, triple, or maybe even in some cases quadruple where they were at just 1 year ago. So the substantially lower rate is probably close to where they entered the premium financing loan proposition, again, a year ago, or maybe even 3, 4, 5 years ago. But this lending platform is not for everyone. Obviously, they are incurring a little bit more risk in terms of the foreign exchange rate. So to kind of illustrate what that means, we'll take a look at this graph here. The orange line represents the Swiss franc value, and the blue line represents the US dollar. So over time, if you go back to the early 2000s, this started on January 1st, 2004, and we ran this through all the way up until January 1st of this year, 2023, we see that the US dollar started off valued at quite a bit more than the Swiss franc. And then over time, we see the value of the dollar dip a little bit below and then kind of hover right around the same value as the Swiss franc and then dip down a little bit lower. So if we look at the standard deviation between these two values over this 20-year period, the US dollar reached a high of 31% greater than the value of the Swiss franc. And at the low point, it was 19.9% less value than the Swiss franc. And that was right around mid-year in 2011. If we look at the volatility over the most recent 10 years, the US dollar reached a high point of 3% greater value than the Swiss franc and a low point of 12.9% less value than the Swiss franc. And if we look at the most recent 5-year period, again, volatility-wise, the US dollar was worth 1.9% greater than the Swiss franc, and at the low point was worth 12.9% less than the Swiss franc. So if we look at the beginning of this year, 2023, on the far right-hand side of this graph, we see that the US dollar was valued a little bit less than the Swiss franc, about 10% less. However, when I looked at this on June 15th of this year, 2023, we see that the US dollar is valued at just over 12% greater than the Swiss franc. And so to measure the foreign currency exchange risk, we're going to compare a US-based lender with US-based rates compared to this Swiss-based lender and the Swiss-based lender's rates. We're going to assume in this case that the client is going to borrow $1 million in annual premium on a 10-pay. So the total loan balance is going to be $10 million cumulatively over that 10-year period. And let's assume the US-based bank rate is 7%. Currently, with a loan this size, our Swiss-based lender's rate, again, as of June 16th, 2023, is 3.94%. So what we want to calculate here is that if the foreign exchange rate does not favor the Swiss-based lender at the time of the loan payoff, meaning that the client is going to have to come up with more US dollars to pay off the same Swiss franc-based loan, how much does the US dollar need to be devalued such that the higher US dollar amount needed to pay out the Swiss bank loan was washed out by the lower borrowing rate offered by the Swiss-based bank? To do that, we'll do a goal seek. And what we're trying to do is get the total out-of-pocket expense paid by the client to be the same and calculate how much less the US dollar needs to be valued at that time. So in this scenario here, US dollar would have to be valued at 17% less than the Swiss franc at the time of payoff in order for the client to break even. But let's just say the Swiss franc and the US dollar were valued at a 1-to-1 ratio at the time of the loan payoff. In that scenario, if the client were to use a US based lender and borrow at a rate of 7%, the total interest the client would have paid would be $3.85 million, compared to the Swiss based lender that offered a borrowing rate of 3.94% at that time. The total interest paid by the client would only be $2.1 million, again, versus $3.8 million. So, again, roughly a $1.7 million savings in interest payments by going with the Swiss based lender. So let's take a look at the borrowing rates with this lender based on the size of the loan. And these rates are for new cases, not refinancing cases, but new cases. I'll talk about refinancing rates in just a moment here. For loan sizes that are $1 million in annual premium, these are the parameters here. So the client would have to have a minimum net worth of $10 million. They would also have to have a $5 million liquid net worth, not including qualified funds. And the amount of liquid collateral they would have to move to the lender in year one would be $2 million. That $2 million could, in theory, be managed by the Swiss based lender using the same exact funds and investment portfolio design as what the client has with their US based money manager. For this size of loan, again, $1 million in annual premium, the current financing borrowing rate would be 3.94%. Again, that's as of June 15th, 2023, wherein the SARIN rate was 1.44%. If the client is borrowing $2 million in annual premium, they would need to have a $25 million net worth, $10 million of which would need to be liquid, and they would need to move $4 million in liquid collateral to the Swiss-based lender to manage. For a loan this size, the premium financing borrowing rate would be a little bit lower at 3.69%. And if the annual borrowed premiums exceed $3 million, then the client net worth would have to be a minimum of $50 million, 15 of which would be liquid. They would need to move a minimum of $6 million in liquid collateral to the lender to manage. And for a loan that size, the premium financing borrowing rate currently would be 3.44%. Again, as of June 15, 2023. So extremely low rates relative to industry norm right now with your traditional US-based lenders. If you have existing premium financing cases that perhaps you need to refinance because clients are extremely upset with their loan renewal rates of, call it roughly 7%. Maybe you're getting a 6% rate. Highly doubt it, but let's just say you're able to get a 6% rate. Even with that type of renewal rate, this type of lending platform might be really attractive to those clients. So if you want us to take a look at refinancing an existing premium finance loan, let's say the total rollover amount, meaning the existing premium financing loan balance you want to roll over to this lender, is $5 million. The client would have to post a minimum of $2 million in AUM with the Swiss-based lender. And for that, the borrowing rate would be 3.94%. Again, which is fantastic. It's sub 4% borrowing rates, which is extremely attractive. If the client was rolling over a $10 million premium financing loan balance, they would still need to move a minimum of $2 million in liquid collateral to be managed by the Swiss-based lender. And for that particular loan size, the rate would be 3.44%. And if they're rolling over in excess of $20 million in existing premium financing loans, they would have to deposit a minimum of $4 million in liquid collateral, and the rate would drop down to 3% because this has a 3% floor despite whatever the SARIN rate is plus the lender's spread. So if we are refinancing existing premium financing loans, we obviously have to charge an origination fee because all the commissions on those policies have already been paid out. So two options with this for the origination fee. Option one, if you have a lender term sheet, right, an official term sheet for the loan renewal with your current US-based lender, the origination fee would be calculated based on 50% of the first year rate savings. So what I mean by that is, let's say your client has a verified renewal rate of 6%. Again, that rate would have to be listed in the official lender term sheet. If the new renewable rate was 3% with our Swiss-based lender, essentially the client would be saving a total of 3 percentage points. The origination fee would essentially be 50% of that 3% rate savings, which would total an origination fee of 1.5% of the premium financing loan amount that's being rolled over. Option two is if you do not have a verified term sheet from a US based lender, for whatever reason, maybe you couldn't find a lender to renew the loan, whatever the case may be, the origination fee would be 1.75% of the total rollover loan amount. So again, using this Swiss-based lender to refinance in-force premium financing cases wherein the renewal loan rate is just unacceptable by the client standards, this could be a really, really great solution for those types of clients. So in summary here, two great new lenders. The first one, again, offers that fixed 5-year rate as low as 5.35%, fixed for the entire 5-year period. And the second new lender on our platform, the Swiss-based lender, is offering rates below 4% annual renewable. Okay, so I hope you enjoyed today's webinar. If you have new premium financing cases you'd like to discuss with us, go to our website, that's lionsmarkcapital.com, and click on Our Services in the top toolbar menu. And if you have a new case you want to discuss, click on the link under Premium Financing Design Request. And if you have an existing policy that you want to either backtest for you or possibly refinance for you, you can click on the link right below that section. Here's the link right here. If you have a policy that you might want to refinance, an existing premium financing policy you might want to refinance using one of these two lending solutions. And right below that, here's a link if you want us to stress test an in-force policy, whether it's financed or non-financed, and we do that for a fee as well. But as always, our goal here at Lionsmark Capital is to provide the very best tools to the advisor community for you to best serve and educate your clients. So this concludes today's webinar. Hope you got great value out of the content, and hopefully you'll take advantage of these tools and resources that we provide. Again, I'm Darren Sugiyama, signing off. Enjoy the rest of your day.